So Warren could see that earning something as small as a penny many, many times over could add up to very, very large sums of money over time. And with that, Warren's obsession with compounding was born. Warren's conceptualization of compounding was so good in his mid-20s that he knew he'd be rich if he could just basically continue compounding his capital at his historical rates of return. So he returned to Omaha with a little over $100,000. And according to inflation-adjusted numbers, it comes out to about $1.1 million today. Today, I'm pleased to share a book on the early days of Warren Buffett. As I've read more books and annual letters by Warren Buffett, I've become more interested in his early days. One aspect of Buffett's career that I'm trying to understand better is his evolution as an investor. And more importantly, what parts of his career are most relevant to investors today. So different investors will take different teachings from what Buffett has learned, and I think he has lessons to impart at pretty much any stage of his investing career, no matter what kind of investor you specifically are. On a personal note, I've noticed myself gravitating more and more towards the early days of his career for a few key reasons. So the first one being, he still abided at this time by many of Benjamin Graham's timeless principles. It's not like you can just say that his early days don't apply to his later days, but there's some things that he did in those early days that he just can't do now. So we're going to be going over some of that in quite a bit of detail. Another thing that gravitates me towards his early days is in regard to the fact that he invested much smaller sums of money. And I believe this allowed him to use strategies that were just not replicable by a lot of other investing legends or investors that are managing larger sums of money, such as where he is today. Thirdly, in the time of the Buffett partnerships, he was hungrier about finding very specific opportunities at a younger age. And he spoke to this in his letters as he aged. That hunger it changed as he got older. And the last one here was that he discussed and detailed the different subtypes of investments that he made and why he was making them. And I really enjoyed the fact that he did this because he was very intentional about the different types of investments he made and he understood them at a really deep level. So I'm really excited just to share all of my learnings with you today. So I've found that I greatly relate specifically to his early days as I personally enjoy looking at a lot of these kind of undiscovered investing opportunities. And this was exactly the type of investing that Warren was doing in those early days. So in the 2024 Berkshire Hathaway annual meeting, Warren mentioned how impressed Charlie was after they met because Warren was aware of some obscure stock based in California that barely any investor had ever heard of. So, Warren, he wasn't always investing in Apple. If you look back to his early days, he was investing in stocks that literally no one really understood other than, Charlie Munger in this example here. So today, I'm really, really excited to discuss a book that I just don't see mentioned that often, but found incredibly informative. And that's going to be Warren Buffett's Ground Rules by Jeremy Miller. So the book is about Warren Buffett's ground rules, which he learned while operating the Buffett partnership. So the author did a wonderful job of summarizing a bunch of large lessons from these days and this part of his career. So he made the book practical. He showed how pretty much any investor could take a very similar approach and why it makes sense. So the way the book was kind of structured was that Jeremy would give his thoughts at the beginning of each chapter, and then he would take passages from the Buffett partnership letters and just allow Warren to give the reader his own reasoning on why he did what he did for his partners back in those early days. So let's get started by discussing the basics of Warren Buffett's ground rules. There were the ground rules, but then he had these primary principles that he followed that he stated, I think, very early in these Buffett partnership letters. So there's three of them. The first one is just the Mr. Market analogy, which I think everyone's going to be aware of. The second one is the business owner's mindset. And the third one is dealing with forecasting. So ardent TIP listeners are probably going to be very well versed in the first of these 2 points that Warren learned from his mentor, Benjamin Graham. But for those who aren't, I want to just briefly go over them in a little more detail so that I'm not leaving you hanging. So the Mr. Market analogy uses a theoretical person that's called Mr. Market to basically just discuss how the market tends to act. Mr. Market will try to trade stocks with you every day. Sometimes Mr. Market is euphoric. In those cases, Mr. Market will charge you a lot of money for the stocks that you want. But sometimes Mr. Market will be depressed and beg you to sell his stock to you at rock bottom prices. Much of the time, Mr. Market is in a neutral mood. So the key point is that you should understand Mr. Market's mood and act accordingly. When Mr. Market is euphoric, it's probably not going to be the best time to buy. Selling might be a better option. And when Mr. Market is depressed, well, buying or adding to current positions is usually going to be the intelligent move. So I just wanted to make a point here that you have to remember that Mr. Market is just a thinking tool. So just because there are areas of the market that are expensive or cheap does not mean everything in the market is expensive or cheap. So the second point here is on the business owner's mindset. So the business owner's mindset basically means that you think of stocks as a fractional ownership stake in a real business. So that means you don't trade the business away on things such as interest rate changes, macroeconomic factors, wars in far-off countries, market sell-offs, or price fluctuations. A business owner just focuses on the businesses that they have, okay? That's very important. So a great example that I really like using when I'm trying to think of this business owner's mindset is just imagining that I personally own a specific business. So I'm in Vancouver, British Columbia. So let's say I own a laundromat in Vancouver, BC, okay? So this laundromat, for the simplicity of this example, we'll say it's debt-free. Let's say I've owned it for 5 years. And let's say that, I don't actually have to do anything. I just own the business and it just produces cash flow that comes back to me and I get a nice dividend check, let's say at the end of each year. So now let's say I've owned this business and then a couple things happen. Let's say interest rate goes up. Let's say there is a war on the other side of the planet. And let's say that the stock market plunges. So then I'm just going to ask myself, okay, would any of these events make me want to sell my business in Vancouver, British Columbia? And realistically, it's doubtful that these events would impact my business at all. Interest rate changes make no difference to my business. People are always going to need to clean their clothes. It's not really a business where you have an option of cleaning your clothes. I mean, you could always go and buy a washing machine, of course, or, use the services of a laundromat. So yeah, interest rates just aren't going to make too big of a difference to the business. And like I said, it's also debt-free. So let's say a war starts. Well, maybe a war could have an impact on the global economy, but it's probably not going to impact the fact that my business just doesn't require me to buy things from impacted areas. So I'm still going to be able to run my business. Maybe there'll be some short-term pricing issues, but for the sake of this example, we'll just say that it doesn't make any difference to my business. And then obviously the last one there, the fact the stock market goes down makes zero difference to me. The stock market going up, down, sideways makes no difference to the amount of dividend payments I'm getting paid at the end of each year. So to me, this is kind of the key to investing in public stocks like a business owner. The other key point to remember is that what happens in your business can often have delayed recognition in public markets. So Buffett sums it up really nicely. The course of the stock market will determine to a great degree when we will be right, but the accuracy of our analysis of the company will largely determine whether we will be right. In other words, we tend to concentrate on what should happen, not when it should happen. So the third point that we talked about here was just kind of dealing with forecasts. So Buffett is not a fan of forecasters. He said prophecy reveals far more of the frailties of the prophet than it reveals of the future. My favorite case study on the frailties of market forecasting and trying to profit from it is examining John Maynard Keynes, one of the most influential economists to ever live. So Maynard Keynes, as he liked to go by, started his investing career by trading and basically attempting to use his superior knowledge of economics to try and forecast what would happen in markets. So for nearly a decade, he toiled in these types of short-term trades, losing 80% of his capital from peak to trough. So pretty rough. He finally smartened up and settled on a different investing strategy. So no longer would he attempt to prophesize market movements. No, instead, he used the value of a stock as his investment guide. Basically, buying when the price was far below value and selling when the price exceeded value, kind of your traditional value investing principles. So next here, I want to move on to Buffett's thoughts on Einstein's eighth wonder of the world, which is compounding. So Buffett was very, very smart about compounding from a young age, and it's quite impressive. So one of Buffett's first books that he read on businesses was Francis Miniker's book called 1,000 Ways to Make $1,000, Practical Suggestions Based on Actual Experience for Starting a Business of Your Own and Making Money in Your Spare Time. Very long title, I know. So Warren learned an incredible lesson, though, on compounding from one of this book's case studies. So in chapter 10 of 1,000 Ways to Make $1,000, Miniker reviews a case study about a man named Harry Larson. So Harry Larson was shopping one day, and some curious person, I guess, that he met there asked him what he weighed. And Harry did not know what he weighed. So he basically went over to a scale machine, threw a penny into it, and got his weight. So an interesting thing happened, though, while he had this experience. As he waited in line to buy whatever he went to go shopping for, he basically observed that there were multiple other customers that were just going up to the scale, putting a penny in, finding out what their weight. And so that just kind of got him interested. So he went over and inquired with the store owner about the weighing machines and just trying to figure out, what are the economics of it. So basically, the store owner made 25% of the machine's profits while doing, pretty much nothing. But the remaining 75% that he was interested went to the owner of the weighing machine. So from there, Harry took some of his savings and just bought 3 of those weighing machines. From those 3 machines, he started making about $98 a month in profit. Now, this next part is what really hit Warren. Harry took all the profits from these machines and then plowed the earnings from those 3 machines into 67 more machines without paying a penny from his bank account. So with 70 machines each earning $33 a month, he would clear about $2,300 a month. So Warren could see that earning something as small as a penny many, many times over could add up to very, very large sums of money over time. And with that, Warren's obsession with compounding was born. So the author points out that Warren's conceptualization of compounding was so good in his mid-20s that he knew he'd be rich if he could just basically continue compounding his capital at his historical rates of return. So he returned to Omaha with a little over $100,000 after working with Benjamin Graham. And according to inflation-adjusted numbers, it comes out to about $1.1 million today. At this point in life, Warren basically figured he'd do a couple very simple things: read a lot and, maybe attend some university classes. But as Warren's wealth grew, he started spending more and more time trying to figure out what the best uses of his wealth would be. This was especially in regard to his children. Warren has famously said that Jesse Owens' child's development would not necessarily be helped by allowing them to start a 100-yard sprint at the 50-yard line. Perhaps you let them start at the 10 or 20-yard line to give them a little bit of help, but you don't want your child basically cruising through life. He felt he would be actually doing them a disservice if that was the case. Well, let's get back to some pretty epic thought experiments that Buffett discussed in his letters regarding compounding. So the first one here was a very popular story about the Indians who own the island of Manhattan. So essentially in 1627, and they sold it for what appears to be a very piddly sum of $24. And Buffett then thinks about, okay, let's say they did sell it, which they did. And now let's say they had an investment advisor who was really good with compounding money at not super high rates of return and could do it for decades and centuries. So basically, he came up with this number, 6.5% return from 1627 all the way. He wrote this in 1965. And his point was that at that 6.5% return, the $24 would return into $42 billion again in 1965. So in 1965, the island of Manhattan was reportedly worth $12.5 billion. So even though they'd sold it, if they were able to compound their money, they still are making multiples of their initial investment, or multiples of what Manhattan would have actually been worth had they just held it for the entire period of time. So I just think that this is such a good story because it really kind of synergizes with most people's difficulty in really understanding the powers of compounding. So as a bonus to the story, Warren also mentioned that, let's say the investor was maybe able to eke out just 0.5% more to get the rate of return to even 7%. So in that case, the value of the initial investment jumps from $42 billion to $205 billion. So that just shows you how, a very, very small increase in your rate of return over a long period of time just amplifies your results. So the other point about this story I found interesting was that it does a really good job of showing how important it is to avoid frictional costs. So things like taxes, commissions, fees really just seem trivial on a short-term basis. But as this example shows, a small decrease in your rate of return can have major effects down the road. This is a good lesson to remember for investors who are paying high fees, either through their own trades or through fees to their managers. So whenever you look at the little statements that have, the very, very fine writing, it's always going to be very, very small. It's going to say this really small amount of management fees, and it looks small to the naked eye, but when you look at what the amount of money that they're actually taking from you over a long period of time, it's not a small number. So just be cognizant of that. So another really cool example here that I actually had never seen before was this example that Warren discusses about the sale of Leonardo da Vinci's Mona Lisa. He goes back in time here. He's going all the way back to 1540 to Francis I of France. So he found out that it was sold for 4,000 acres. Warren was kind enough to give us the exchange rate and came to a figure in 1964 of about $20,000. So he pointed out, again, if Francis I had a trustee who maybe could have found another investment that compounded at 6%, that the money that he spent on Mona Lisa would have been worth 1 quadrillion in 1964. So a quadrillion, just because it's not a normal number, it's basically a 1 followed by 15 zeros. So Warren also noted that this number represented 3,000 times the US's national debt in the same year. So, both examples here just show how an unfathomable amount of money can be made through compounding and through compounding over long, long periods of time. Now, obviously, we don't all have the luxury of being on Earth for multiple centuries, but the point still stands, even if you can do it just for a couple decades, it's very, very powerful stuff. So I think the fact that Warren also understood compounding at such a good level was also part of the reason why he just didn't like spending very much money. He understood very well that a few $1,000s today would be worth a heck of a lot more money, maybe a couple decades into the future if Warren Buffett could basically put that money into his compounding machine. So the primary lessons, I think, from this chapter on compounding is just how important it is to really, really understand it. Not only can it generate wealth for those who understand compounding, but it can also be used as a sort of brake on spending if you truly feel the pain of buying. Let's say you buy a used car, and maybe the used car, maybe you have option 1 and option 2, and maybe the second option is $10,000, $20,000 more expensive. Well, if you understand compounding really well, and maybe you can see into the future and you know that you're able to compound money, well, that $10,000 and $20,000 difference can make a huge difference in 50 years if you can compound it. So I think it's just an interesting kind of thought experiment to use if you need help to rein in your spending, just to kind of see the opportunity cost of spending money. So now I want to take a turn here and kind of look at the other side of frictional costs that I just discussed, namely how individuals and institutions get taken advantage of for being overactive. So the problem is kind of hidden in the fact that people who urge you to be active are actually incentivized to increase your rate of transactions. So a broker makes nothing if you hold stocks for decades, but if you decide to day trade, that broker will be your best friend, as every buy and sell that you do will be slowly padding his pockets while unfortunately lightening your own. And I think this concept goes much further than, just the world of investing. For business owners, some people will approach you with some magical fix for a problem you never even knew you had. These frictional costs can add up, and they can mean the difference between running a business into the ground versus running a successful business for decades. But Warren's advice to investors is really quite simple. Quote, resulting frictional costs can be huge, and for investors in aggregate, devoid of benefit. So ignore the chatter, keep your costs minimal, invest in stocks as you would a farm, unquote. So this chapter does a wonderful job of showing why and how Warren developed his disdain, I think, for much of the financial world. Through his in-depth understanding of compounding and his ability to, see how big of a difference fees could make, he explained why he preferred index funds, which did not yet exist at the time of these writings. So here's what Warren said about investment companies in the 1960s. The result of these investment companies in some way resemble the activity of a duck sitting in a pond. When the watermark rises, the duck rises. And when it falls, back down goes the duck. I think the duck can only take credit or blame for his own activities. The rise and fall of the lake is hardly something for him to quack about. The water level has been of great importance to Buffett Partnership's performance. However, we have occasionally flapped our wings, unquote. So this final sentence here is so important. We have occasionally flapped our wings. This means that he's essentially added value to his partners through his thoughtful investing skills. So the crazy part about all of this is that the fund industry, today is essentially the same way it was back in the 1960s. Funds are searching for ways to just kind of match the index. Certain people have been able to kind of take advantage of the changing tides in the price just by floating with the market. So I think a really good example of this is ARK funds ran by Cathie Wood. So I think, during COVID, obviously the ARK funds were doing really, really well. and investors flocked into it, putting tons and tons of money. So during the height of ARK on February 13th, 2021, it was actually up 737% versus 120% for the S&P 500, an astounding difference. But using Buffett's analogy, investors, I think, thought that ARK had flapped its wings to create this value. But in reality, it was propped up by a mix of factors and largely propped up by a rising tide in all stocks. And when the pond drained and the ducks floated back down, ARK ended up with lower returns than the S&P 500 at about 150% versus 231% over the prior 10 years. So what accounts for this lack of performance by institutions versus unmanaged indexes? Is it intelligence? How about integrity? Buffett actually did not attribute the lack of performance to either of these factors. Instead, he attributed it to 5 things. First, group decision-making. So Buffett, he just did not believe that outstanding management could be the product of a group making decisions. Number 2, orthodox thinking, which basically is mindlessly copying what other people in the industry are doing. Third, the safety of average. If you get the same results as everyone else, you are seen as successful, even if that success was a result of undue risk-taking. 4, following standard diversification dogma. And 5, inertia. So he made this statement back in 1965, and I think these points are just as valid today and will probably be valid in another 50 to 100 years from now. So this kind of makes me think about some of the investors who I won't mention by name, but a lot of them started as really, really successful hedge fund managers, but then things kind of started changing as they scaled up their assets. So here's kind of a narrative for how some of these investors go. So they start as upstarts, right? They're often working on their own, or maybe they have a partner and they have a lot of success and they make very, very high returns. But as they start scaling up, they need to bring on more employees and, increase the size of the business and maybe, get more back-end people involved. And as they get more and more of these employees, the employees who've probably worked at other firms or coming out of school, they mimic the behavior of other people doing things, like everyone else's. So the returns the fund once had are no longer achievable. And they basically take safety in just being average and tracking the returns of the markets and even, their competitors. So, they used to have these very concentrated funds, most of them. And then all of a sudden you look 10, 20 years in the future and now they have 100 positions. So it kind of looks like they're just essentially trying to track the industry. And then finally, you can't really go back once you've taken this route. That's kind of where you're stuck. It's hard for you to go from 100 positions to 10 positions. Your investors are probably going to be perplexed as to why you're doing that. So essentially they just kind of stick with it. And, that's what everyone else in the industry is doing. And so they've been doing it now, and they probably, they might have billions of dollars under management and it works. So they just stick with it, kind of like the lemmings example that Warren Buffett says that, people just like doing what everyone else is doing. So I think the lesson here is best aided by the use of one of my favorite mental models, which is inversion. So if we know what accounts for the lack of performance, then if we want to perform really well, let's just avoid being guilty of a lot of these mistakes. We know what the mistakes are, so let's invert them. So there's 5 things we want to do. We want to make our own decisions. We want to think like a contrarian, think differently. We don't want to chase average results. We want to chase some sort of result a little bit above. It doesn't have to be super high above, but we want to chase a result that's not average. We want to concentrate our investments on our highest conviction ideas. And then lastly, we want a willingness to improve our previous strategies when we have mistakes that are identified. We don't want to just get stuck doing the same thing over and over again that doesn't work or isn't, giving us the returns that we're looking for. So this ability to think independently and chase out performance is a really good segue, I think, into the next part of the book that I want to discuss, which is how Warren compared his performance to the index. So when Buffett wrote the Buffett Partnership letters, he was competing with the Dow Jones Industrial Average, or just the Dow. So the Dow is composed of 30 prominent companies listed on US stock exchanges. Many investors, follow this index simply because it's just a good benchmark for determining whether they're adding any value to the investing process. And sadly, most investors, both retail and professional, lag the index. But because of some of the problems that we've just discussed, it is tough to beat the index. for the few that are beating the index, they're probably following those 5 tenets that I just mentioned when we inverted them. So let's kind of get into how Warren compared himself to the Dow and some of the specifics about how he thought his partners should evaluate his performance. So Warren thought that he should be compared to the index on kind of a 3 to 5 year basis. So the reason he liked this format was that it would show his portfolio performance both through an upcycle and a down cycle. Warren felt that a good investor should be able to perform well in pretty much any environment. Warren went so far as saying, quote, "If any 3-year or longer period produces poor results, we all should start looking around for other places to have our money," unquote. But we must also keep in mind that the index can do some pretty wild things. Since the market in the short run is a vehicle for the overall mood of the market, one can underperform the market and still be doing a very good job of investing. And Warren understood this very, very well. So throughout his letters, he constantly mentioned that Buffett partnerships would probably underperform in bull markets and would often outperform in bear markets. And it was, in fact, expected that the performance of Buffett partnerships would fluctuate and it would sometimes underperform. So another interesting point here was that Buffett considered a year in which his fund declined 15% versus a 30% decline for the index to be a superior year where both his fund and the index, let's say, advanced 20%. And this kind of goes with that ducks analogy that we just talked about. So he has a quote here. "Over a period of time, there are going to be good and bad years. There is nothing to be gained by getting enthused or depressed about the sequence in which they occur." So I think this really speaks to Buffett's ability to think long term. In the appendix of this book, you can see the results of Buffett's partnerships. And even though he never had a down year versus 5 down years for the Dow, he did have wildly varying results. From 1957 and 1969, he only underperformed the Dow an insanely low 1 time. So I don't even think Buffett would have predicted that going into the partnership. Another point on performance that Buffett really emphasizes was basically how anyone managing money should be able to state 2 things. So first, they should be able to clearly state the returns that they are attempting to achieve. And second, they should be able to state how the investor should be measured at achieving those returns. So this means that people managing money should not continuously change their yardsticks. You don't want to be looking at a manager and maybe you went back 10 years in time and, let's say they're having a really, really good year. And because they had a really good year, they may overpromise their investors in the future saying, okay, we did 50%. So, who knows, the sky's the limit for going ahead. And unfortunately, you got to put a break on that kind of thing because that's just not the way things work. And one of humans' most powerful biases is that we do attribute skill to lucky outcomes very often in a large magnitude. This is just a point that you should be aware of managers who are changing their yardsticks during the good times, because chances are that, the good results that they're having over a short period of time will regress back to the mean. And oftentimes, a very large outperformance can be followed by a very large underperformance. Just keep that in mind. If you paid attention to the markets in 2022, you'll see that in 2021, there were some funds that did it incredibly well in 2021 and then went down like 50% or more in 2022. So Buffett's points on not attempting to beat the market during wild market swings is very valuable because I think it helps investors avoid trying to chase higher returns that are often accompanied by higher risk. This is precisely why Warren shut down the partnerships in the late 60s, which we'll be going over in some more detail later. Jeremy Miller does a great job at the end of this chapter discussing why performance measurements today has been largely corrupted and obfuscated with terms like alpha, beta, Sharpe ratios, trainer ratios, and so forth. It doesn't have to be all that complicated. Investors who decide to go the active route simply need to think it through ahead of time and commit to sticking to a measurement plan. Now, I just think this is wonderful advice. And to be honest, I don't have a firm grasp of many of the terms he listed above because I just don't think they matter to my personal investment goals. So just be wary of salespeople that are using, overly complicated terms to try to justify you paying for mediocre results. So I wanted to end this section here with just a case study, I think, on one of my favorite investors, which is Francois Rochon, who Clay interviewed recently. So I would highly recommend reading his shareholder letters regularly. They're very, very much worth it. One thing that I really like about him is just how simple he makes things. So I opened up his latest letter and just searched for all those words, Sharpe ratios, trainer ratios above, and you can't find them. He doesn't mention them once. Instead, he's basically telling you what returns that he's attempting to achieve. So basically, he's trying to achieve 5% higher than their benchmark. So because he invests not just in one geography, he's using a hybrid index. So he's using the S&P TSX Composite, the S&P 500, the Russell 2000, and the MSCI EAFE. So he does a really good job of clearly showing the results he's had versus the index since the inception of his fund back in 1993. He's not changing things or blocking numbers out. And I went back, 20 years to, I guess that would have been 2004. And the benchmarks were all there. They were the same. I mean, he wasn't using MSCI EAFE, but all three other ones were there. He's using the same index throughout. And I think that's really powerful. And I think that that can give you just a really good picture of the type of investor that he is, and that he's obviously a very highly skilled investor as well. So now that we have a better understanding of what Buffett used to benchmark his performance, let's look at the partnership structure that he made in a little more detail. So Warren doesn't talk much about cloning, but his fund clearly was cloned from Benjamin Graham. Graham had kind of pioneered this structure with a general partner, a GP, who managed the fund and then took a percentage of profits. And limited partners, LPs, who basically contributed capital and took part in the gains and losses, but had no part in managing the capital. So although Warren is very well known for being incredibly intelligent on investing at a young age, he wasn't necessarily predestined to manage money. So here's what Buffett said about how the fund was initiated. Quote, "By pure accident, 7 people, including a few of my relatives, said to me, 'Hey, you used to sell stocks, and we want you to tell us what to do with our money.' I replied, 'I'm not going to do that again, but I'll form a partnership like Ben and Jerry had, and if you want to join me, you can.' My father-in-law, my college roommate, his mother, my aunt Alice, my sister, my brother-in-law, and my lawyer all signed on. I also had my $100. That was the beginning, totally accidental." So the fund was quite simply structured on this 0-6-25 system that barely any funds follow today. So basically the way it was that he took a 0% management fee. He had this 6% interest provision, kind of like his watermark that he had to beat. And then past that provision, he would then take 25% profits. So basically, in essence, he was offering a 6% return to his investors before taking a penny for himself. So I've kind of always wondered where the 6% number came from. And the book's author mentioned that Buffett figured that the market at this time would go up 5 to 7%. And he just kind of split the difference with that 6% watermark. An interesting feature in the structure of the fund was that some people planned on investing in the fund and then using the proceeds for income. Others wanted to just keep their money in the fund to maximize the amount that they had invested. To appease both parties, Warren would allow investors to keep their capital in the fund for those who did not want the income. It would just be reinvested the following year. And for those that did want income, he would basically distribute 0.5% each month, which comes to that 6%. So this is one of my favorite partnership structures, and it's hardly used by the financial industry today. So the norm is a 2 and 20 structure. So in this structure, the manager takes a 2% management fee based on the assets under management, and then they take 20% of any profits. So the problem with this structure is it does not align the manager, in my opinion, with its investors. So let's go over some of the issues with the 2 and 20 system. So the manager has zero exposure to the downside. The manager does not lose anything if the fund goes down, say, 10% in a year, but obviously the partners do. Since the managers incentivize on assets under management AUM, they are encouraged to increase AUM rather than increase shareholder returns. So for instance, let's say a manager takes AUM from 1 billion to 2 billion. In the same, 2% management fee, that means that their fees basically go up from 20 million to 40 million just by increasing AUM. But during this time, they could theoretically have zero returns and basically be offering no actual value to their partners, and yet they're doubling their fees. The alignment there is just, it's off. So the 20% performance fee can also force managers to take undue risk in kind of a short time frame. Since they have no downside, managers might be looking to invest in strange products, derivatives, expensive stocks, maybe trying to ride momentum, all while ignoring potential downsides because, like I said, they don't lose anything if the value of the fund goes down. And lastly here, the compounding effects of these fees do really eat into the returns of the shareholders at an alarming rate. I think we covered that pretty well in the section there on compounding. So I personally am always emphasizing the importance of partnering with aligned management teams in the businesses that I personally invest in. And I don't think that advice should change for investors looking for managers to invest with. Search for managers who are incentivized to make you money, not just collect fees. A good manager should have to face the pain of losing money for the fund, just like their investors will feel if money is lost. So even though Buffett mentioned the $100 that he put into the fund, I believe this was just at the very, very beginning. The evidence for this is in his 1960s letter to partners while discussing provisions to the fund. So he actually mentioned that his and his wife's life savings were invested in the Buffett partnerships. He also said that they were the single largest investor and that they owned about 1/6 of all the partnership's assets. So to me, this is a cherry on top of an already excellent partnership structure. So the next section of this book that I want to cover is going to be about the investing buckets that Warren Buffett thought about for the fund. So this book discusses 4 investment types. 1, the generals. 2, workouts. 3, controls. And 4, asset plays. So we're going to go over all these in a little more detail. We're not going to talk too much about asset plays, but let's start off here by talking about the generals. So generals made up the largest percentage of the portfolio.
Hey guys, it's Clay Fink here, host of We Study Billionaires. If you're like me and enjoy listening to podcasts, then you'd probably enjoy listening to audiobooks as well. Whether it's when I'm doing the dishes, going on a walk, or driving to the gym, audiobooks are such a great way to continue on this journey of lifelong learning. And if you haven't signed up for Audible yet and you'd like to support We Study Billionaires, I'd encourage you to use our affiliate link and start accelerating your learning journey today. Also, if you haven't read my co-host William Green's wonderful book, Richer, Wiser, Happier, I'd encourage you to start with that one. Immediately after you sign up for your Audible subscription, you can start listening to William's book for free. Some of my other favorite investing books include 100 Baggers by Chris Mayer, The Joys of Compounding by Gautam Baid, and Same as Ever by Morgan Housel, all of which have been previous guests on the podcast. To sign up for Audible and to support We Study Billionaires, you can head to theinvestorspodcast.com/audible. That is theinvestorspodcast.com/audible. We appreciate you supporting We Study Billionaires.
He kept their names highly secretive. And I think the simple reason for this was that since many of these businesses were small and illiquid, he didn't want to necessarily have to compete with his partners to acquire shares in these generals. And another potential reason for keeping his investments a secret could have been to help him control biases. So the specific bias I'm referring to is commitment bias. In the Nomad Investment Partnerships, they wrote, "Commitment bias occurs when we publicly disclose our positions, which most definitely affects our objectivity towards the position." So in investing, as anyone who has held a losing position knows, we need to be able to let go of an idea when it doesn't fit with our initial hypothesis. So perhaps Warren believed that sharing the names of his generals would bias him into making poor decisions and lower his willingness to part ways with an idea if partners, family members, friends, and colleagues knew he was invested in. So after speaking with Annie Duke on TIP662, I learned how to best handle commitment bias. In her book, Quit, she has some great passages on why quitting is so hard. Whether it is on the level of an individual, an organization, or a government entity, when we're getting bad news, when we are getting strong signals that we're losing, signals that others plainly see, we don't merely refuse to quit. We will double and triple down, making additional decisions to commit more time and money and other resources towards the losing cause. And we will strengthen our belief that we are on the right path. This means that when all the signals say we are wrong, we can often become even more stubborn. My favorite tool she outlined to combat this bias was what she called kill criteria. So kill criteria has 2 parts, a state and a date. It's very simple. So here's an example from my own portfolio. So I own a business called Aritzia, which I haven't spoken too much on the podcast about, but let's use that business and see what one of my kill criteria might look like. So I've made it a habit now since learning about these kill criteria to make them for every single business that I own. But one of the ones that I noted for Aritzia specifically was to do with gross margins. So essentially the kill criteria is, okay, if Aritzia has gross margins below its 10-year floor of 36%, and that's again over a 12-month time period, then that's a kill criteria. So you can see this kill criteria has both a state and a date. The state is, gross margins below 10-year floor, and the date is 12 months. So obviously it's floating. I don't have to say, okay, in the 12 months from now, because they just had their latest quarter and they're not, the numbers are way higher. So, it wouldn't really apply now. So that's kind of why I made it a 12-month period. Maybe it needs to be longer, maybe it needs to be shorter. It's completely dependent on you and what you're comfortable with your business. Now, if this kill criteria were to happen to one of my businesses, I could make up excuses to hold on longer. But if I have this kill criterion, the excuses will hopefully just go out the window and I'll sell the business. And this would be a very good signal that the business might be in for some long-term trouble. So if this kill criteria was actually hit by the business, I think it's a really good signal that the fundamentals of the business are maybe falling apart. And, I wish I'd had this framework for some of my businesses in the past, because I feel like, if I'd made the kill criteria, a lot of them probably would have been hit and I probably could have sold out a lot earlier and lost less money. So I think that's why kill criteria do have so much value. Now, I don't know if Warren Buffett ever actually used kill criteria, but given his intelligence and rationality, it would not surprise me one bit if he just wanted to avoid his own biases as much as possible. And I think keeping his ideas a secret might have been a really good technique for avoiding those biases. As with all Buffett investments, the generals were acquired at a discount to intrinsic value. He took this notion even further and actually sought to look for discounts to private market value in public markets. So this was a pretty incredible undertaking. After all, many private companies go public specifically because they want to increase the value of their holdings of their shares. So generally speaking, public valuations are just higher than private markets. So Buffett knew that if he could find these generals trading below private market prices, the multiple re-rating alone could deliver very impressive returns to Buffett and his partners. With his generals, he also knew that he could heavily invest in a single idea. For instance, Buffett invested 10 to 20% of the partnership's assets into Commonwealth Trust Co. in 1959. He calculated the intrinsic value of Commonwealth to be around $125. The price at the time was $50 on earnings of $10 a share. So he was getting a 20% earnings yield on the business. In a 1964 letter to partners, he further discussed the advantages of the general segment. He wrote, "There is often little or nothing to indicate immediate market improvement. The issues lack glamour or market sponsorship. Their main qualification is a bargain price. That is, an overall valuation on the enterprise substantially below what careful analysis indicates its value to a private owner to be." In typical Buffett fashion, he displayed his trademark contrarianism that has helped fuel his investing career. Now, I want to touch on this concept of market sponsorship because it's an area that I've noticed more and more over the past year. So when I first started investing, market sponsors were a completely foreign concept to me. I don't think I spent a second ever actually thinking about it. But, back then I was also investing in larger businesses, and I don't think that market sponsors were necessarily needed because so many people in the market just knew about the business and their products. But once I started investing in some of these small cap businesses, then I started realizing, okay, this sponsorship idea is actually really, really powerful. So there's one that I own, a small cap that I won't mention its name, but it's a business that has an incredible product. But the problem with it is that the product is just not very well known by anyone, including their customers. So they actually literally have to go out to their customers, say, "Hey, look at our product. It's really good. Here's what it'll do for you. Here's how much money it'll save you." A business like Amazon, they don't have to do that. Everyone listening to this probably used Amazon once or twice and knows that they know what Amazon does. So, just understanding this difference here between small caps and larger caps and the different types of products and services that they sell, it's just really showed me how important having that sponsor is. Because, if you have the right person or, company or whatever that does the sponsor work for another business, it could just be really powerful, right? Because not only can it bring that idea to other potential investors, but it can also help just spread the word on their products, which kind of has this second order effect of also maybe even helping the business find more actual business partners to sell their product to. So one of the big problems is that a lot of these smaller businesses just kind of flounder in obscurity for long periods of time because investors don't know who they are, and they just a lot of people just don't know what their products are. So I think a market sponsor, especially in these smaller businesses, can really help solve this problem by just getting exposure to the business, both in terms of finding other investors, but also maybe even finding customers for his products. So the last point here that I want to make on generals is that Buffett was looking at very, very boring businesses. So as the Buffett quote I just referenced points out, they tend to lack glamour. And I think this risk really plays to Buffett's avoidance of technology, but also more importantly to his avoidance of overpaying for stocks and for assets. So the next type of investing bucket the book covers here are workouts. Another really easy way to think of workouts is just as arbitrage. For instance, if you can find, let's say, the same stock trading on two different exchanges at different prices, you just buy it on the cheaper exchange and then sell it on the more expensive exchange. And there you go. There's your arbitrage. So one of Buffett's best known arbitrage deals from his past was in Rockwood & Co. So this was a business that really seemed like a very lousy business with very minuscule profits, but they were a chocolate business. And because they were making chocolate, they also owned large amounts of cocoa, and they had cocoa sitting in their inventory. And Buffett had found out that this cocoa that they were sitting on in their inventory was acquired at about 5 cents per pound. So in 1954, there was a shortage in cocoa, and this was causing a major supply-demand imbalance. And because of the imbalance, it was shooting the price of cocoa up to over 60 cents per pound. So Rockwood was pretty intelligent about it, actually. They decided basically they wanted to sell their inventory of cocoa to take advantage of this temporary cocoa bubble. But there was a problem. They couldn't just sell the cocoa by itself, because if they did that, they would have had about a 50% tax on the proceeds, which was very high, and they didn't want to deal with that. But the tax code came to the rescue. So there was a provision in that tax code that last in, first out profits of inventory could actually be distributed to shareholders as part of a restructuring plan for the business. So basically, Rockwood had to terminate one of its businesses to satisfy this restructuring requirement. And then the sale of 13 million pounds of cocoa being inventory was part of that downsizing. So in order to return value to shareholders, they basically would buy back their shares in exchange for cocoa beans, paying 80 pounds of beans per share. So Buffett said here, for several weeks, I busily bought shares, sold beans, and made periodic stops at Schroeder Trust to exchange stock certificates for warehouse receipts. The profits were good, and my only expense was subway tokens. So Buffett basically would buy the Rockwood shares at $34, then exchange the beans worth $36. So there, his arbitrage was just $2. And, obviously keep doing that over and over again, and it's a decent little deal. The only thing that was really needed in order to make sure that this arbitrage continued to work was that the price of cocoa beans had to remain elevated. Obviously, if cocoa beans kind of went back down to its normal price, then the arbitrage would no longer work. You might end up losing money. So you can see how this type of arbitrage can create some interesting short-term profits. But, there's not really much compounding available, because the arb deal eventually is going to be found out by people, and the arbitrage between, the buy and the sell price closes, and it doesn't last for very long. So, merger arbitrage just doesn't really necessarily seem like a very scalable strategy, but Buffett still employs it. As recently as 2023, he was part of the Activision and Microsoft merger. So Buffett saw Activision shares trading for $73 a share. And then the proposed acquisition price by Microsoft was actually $95 per share. So although Warren would end up selling 70% of his initial investment for the merger, he was still able to eke out a $1.4 billion profit on the merger arb. So pretty good. So even though workouts require a lot of work, and I think is probably the opposite of sit on your butt investing that Charlie Munger was such a proponent of, it really did have great results for Buffett. So as the book's author Jeremy Miller outlined, using the record of Graham Newman, Buffett Partnerships, and Berkshire Hathaway in the 65 years through 1988, Buffett figured the average unleveraged returns in the arbitrage business was about 20% per year. In the annual report that year, he said, "Give a man a fish and you feed him for a day. Teach a man arbitrage and you feed him forever." Indeed, we know what 65 years of 20% average annual compounding does. It turns $100 into $14 million. So another investment bucket that Warren used here is what he called controls. So the simple way of thinking about controls is just as activist investing. Think of investing legends such as Carl Icahn or Bill Ackman, and I think you're going to be on the right track here. Controls require that the investor kind of have to get their hands dirty and often do things that might upset the traditional way of doing things inside of a business. So let's jump into the Sanborn Maps case study that's outlined in the book. Sanborn Maps was a business which required a jolt to a system in order to unlock its full value. And Buffett basically would be that jolt. So what did Buffett see in this business in the first place? The business was quite simple. It had two value levers. First, it basically just sold maps to insurance companies. So revenue had declined in the previous 20 years. But even though it had declined, it basically was unlikely, very, very unlikely to go to zero because the product had very, very high replacement costs. So these insurance companies would just keep on shelling out money to Sanborn Maps specifically for the maps. And then the second value lever was just that it held an equity portfolio which distributed dividends. So this is the important part. When Buffett found it, the map business was being evaluated at minus $20, with the stock owners unwilling to pay more than 70 cents on the dollar for the investment portfolio. So he put money into the idea, a lot of money, in fact. He put in 35% of the partnership's assets just in this one bet. So he knew that the equity portfolio alone was worth more than the entire business's market cap. So he bought up shares from unhappy shareholders and established a board seat for himself. Though he had to go through some pushback, he eventually got the business to basically sell off its stock portfolio and distribute it back to shareholders. Buffett ended up making about a 50% profit on this investment in less than 2 years, which is somewhere around a 22.5% compounded annual gain. I wasn't exactly sure on the date, so it probably if the date was shorter than 2 years, that compound annual gain is going to go up. So now let's look in how Warren valued these controls, because he obviously he's conservative in everything else. He's probably going to be conservative in the controls as well. So Warren wouldn't use an appraisal of what he thought the control would be worth in the future. Basically, it wasn't a number that he hoped it would be worth, or even a number that, say, an overeager buyer would pay him for it. Instead, he basically would use a number that he felt was realistic to sell under current market conditions in a very short period of time. Another interesting point on valuation is how Buffett would use assets a business owned to calculate its value, the more traditional type of value investing. On this subject, Jeremy Miller made a great point. Quote, "When you do your valuation work, the assets are always worth what they can be sold for, and the liabilities are always assumed to be due in full. That's the difference between accounting value and economic or intrinsic value," unquote. So his point is that valuing a business based on asset value requires making adjustments to those assets. Assets for lower quality businesses tend to not trade at par value. So adjusting them downwards at a conservative increment would probably yield the most conservative type of valuation. Benjamin Graham had some very rough rules of thumb here. He would ascribe 100 cents on the dollar for cash, 80 cents on the dollar for receivables, 67 cents on the dollar for inventory, and 15 cents on the dollar for fixed assets. Buffett stopped investing in controls a few years before closing the partnership down. In a 1968 partnership letter, he discussed the importance of doing business with people that he liked. He also pointed out that although controls might offer higher returns, it got to a point where it just was not pursuing for Warren personally due to the aggravation of dealing with people who did not want to do business with him. So he said, "It seems foolish to rush from situation to situation to earn a few more percentage points. It also does not seem sensible to me to trade known pleasant personal relationships with high-grade people at a decent rate of return for possible irritation, aggravation, or worse at a potentially higher return." So the final point on controls I'd like to touch on here are why he had the segment in the partnership in the first place. So as previously noted, he eventually grew tired of investing in controls. But before he reached that point of peak aggravation, there was a reason that controls actually existed. So they were actually a hedge to his larger allocation into generals. Because controls would eventually be valued fairly in a reasonably short period of time, they could prop up the returns of the portfolio during times where the generals were lagging a little bit. Additionally, controls had asymmetric upside. There were really only two outcomes. One, the market prices the business closer to intrinsic value, and then Buffett would sell at a profit. Or two, the market continues to underprice the asset, in which case Buffett just buys more until the market comes to its senses. So the next section of this book that I found fascinating was on the chapter called Conservative versus Conventional. Now, this chapter does an exceptional job explaining some more of the details on why Buffett placed such a high value on contrarian views and why other investors should place very little emphasis on conventional views. Warren's views on the opinions of others was largely molded by, I think, his relationship with his father. So his father was a fan of some of Ralph Waldo Emerson's greatest philosophical concepts, self-reliance being one of them. Now, this is why Buffett did not take solace in whether or not the market agrees with him. It also meant that he was ambivalent towards the thoughts and opinions of those with high levels of influence and authority. Another great concept he learned from his father about conservatism was that, conventionally speaking, once the consensus was in agreement, a thought or opinion was considered conservative. So if you go through all of Buffett's investments, most of them were not bought when the consensus viewed that stock in a positive light. So a great example of this, straight from Warren Buffett, is just Apple, right? He started buying Apple back in 2016. So he bought it at very low double-digit PE multiples, say around 10 to 12. Now, a stock trading at a PE of 10 to 12, especially in kind of the tech area, definitely does not scream consensus to me. And another interesting point here is that since 2021, Apple has never sold for a price to earnings ratio of less than 20 times. So he's done really well on this investment. Both because obviously his returns have been very good, but he obviously bought it when it was out of favor, knowing that it would, at some point, I'm sure he had no idea when, it would be back in favor, which it's been now for quite a long time. The odd thing about Apple is that many hedge fund managers probably saw it as a very conservative investment at 20 times earnings because the consensus view was somewhat similar. So in the 1965 letter to partners, Buffett wrote, "We derive no comfort because important people, vocal people, or a great number of people agree with us, nor do we derive comfort if they don't." A public opinion poll is no substitute for thought. When we really sit back with a smile on our face is when we run into a situation we can understand, where the facts are ascertainable and clear, and the course of action obvious. In that case, whether conventional or unconventional, whether others agree or disagree, we feel we are progressing in a conservative manner. Now, Warren's propensity towards concentration is pretty well documented. As I've already outlined, Warren liked to invest large portions of the partnership's assets into a single opportunity if the risk and reward was right. So in the 1990s, Warren gave a speech to a group of students. In it, he outlined the following diversification criteria. He's basically said 6 wonderful businesses is all the diversification that you need. Investing money into your 7th best idea is probably going to be inferior to investing in your best idea. He made a point that very few people have gotten rich investing on their 7th idea, but many people have gotten rich off of their first idea. And then his final point here was that for anyone working with normal capital, 6 positions is great, and he would actually put half of his capital into his most loved idea. So Warren is known for well over 50 years that orthodox views on diversification are just plain silly. In his 1964 letter to partners, he wrote, "If good performance of the fund is even a minor objective, any portfolio encompassing 100 stocks, whether the manager is handling $1,000 or $1 billion, is not being operated logically. The addition of 100th stock simply can't reduce the potential variance in portfolio performance sufficiently to compensate for the negative effect its inclusion has on the overall portfolio expectations." So I just loved this point here. He's definitely been quoted about it a lot in regards to diversification. But the thing that's always kind of confused me about being diversified is just trying to come to grips with understanding 100 businesses well. Like I think that maybe that's part of the reason for the fund industry, right? A lot of these funds will have, many analysts, right? So if you have a team of 20 people, then sure, maybe each person gets 5 businesses and they can understand them at a high level. And that's kind of how they justify it themselves. But as an individual, 6 businesses, I think, yeah, you could definitely understand that. Maybe you could go take that up to 10, 15, whatever. Depends how much time you have in your day, but it doesn't make a lot of sense to try to have 100 businesses because you're just not going to understand it at a very deep level. Maybe you can do things where you're only looking at the business. Let's say you're reading their annuals and their quarterlies and maybe listening in. That's probably all the work that you're gonna be able to do if you have a ton of businesses. But that means that you're also disregarding a lot of other work that could be really helpful, such as looking at competitors, looking at the industry, talking with people involved in the business or maybe customers or suppliers, all these other things. All these things take time, right? And there's only a certain amount of time in the day. So if you have a lot of ideas, it basically means that you're spreading yourself thin and you're probably not going to understand your businesses as well as if you were a more concentrated investor. So I guess, if you have no edge in the businesses that you own or you don't have the desire to, then you are, best off diversifying. But the beautiful thing about that is you can just buy an index fund and not actually have to spend a second of time looking into the individual stocks that you own, and you can probably just do really well. So the final point from this chapter I want to discuss is on time horizons and performance. So Warren was perfectly content with having a high variance of returns from year to year. Between 1957 and 1969, Buffett Partnerships maintained its margin versus the Dow ranging from a low of 2.4% to over 38%. So this meant that the partners had to make do with a wide variance. Now, many investors might be unwilling to have such large swings in portfolio returns, and that's okay. But Warren used the fact that he was chasing long-term returns to his advantage. Warren knew that he would have been able to smooth out his variance if he wanted to and accommodate maybe some shorter-term partners if he wanted to. But doing so would have sacrificed the overall performance of the fund in the long term. Now, one of the aspects of Buffett's early days I find most enticing is how the role of size affected his performance. So his funds started in 1958, but by 1966, he was actually no longer taking on outside capital as his capital was growing too quickly for him to continue using the strategy that had been working so well. So Buffett Partnerships AUM was $43 million in 1966, and he said at this time that as circumstances presently appear, I feel substantially greater size is more likely to harm future results than to help them. This might not be true for my own personal results, but it is likely to be true for your results. So the point on size and performance is profound and I think worth digging into a little deeper. Why would scaling up lead to decreased performance in Buffett Partnerships? There are two primary reasons. The first is an inability to invest in obscure businesses with inefficient prices. As you grow larger and larger, you have to find larger and larger businesses to invest in. And I think while, yes, you can find inefficient pricing in those, it's just a much lower frequency. And the second one is just market cap problems. If let's say he wanted to stick with these smaller ones, he could theoretically do it, right? But the position sizes would be small, right? And sure, maybe he could find something that could double in the next year, but if he could only put 0.5% of his fund's assets into that one idea, well, it wouldn't make too big of a difference to the overall returns. So if we look at Buffett Partnerships' performance through its life cycle, it returned 29.5% compounded annually before fees. So it's too bad that Buffett didn't track intrinsic value at the time, but it probably just didn't really make sense given the sense of the structure of the fund. But if you look at the book value of Berkshire Hathaway, which Warren has said is a good proxy for long-term returns, you can actually see that the book value is growing at a decreasing pace. So I went back and looked in 2000 and the CAGR of book value at that point was 24%. And in 2024, that's dropped to 20%. And my assumption is in 20 more years, it's probably going to be some number less than 20% as well. Now, if we look back at just the past 10 years, book value has grown at a compound annual growth rate of only 9.8%, and market cap has grown at a compound annual growth rate of 9.6%. So the point is obviously that Berkshire Hathaway has slowed down its growth as it has scaled. And unfortunately, that's kind of just an inevitable consequence of scaling. It can't go on forever. So the important takeaway here is that if you are working with modest sums of money, you do not need to follow in the footsteps of money managers who are investing large sums of money. Avoiding businesses with small market caps does you a disservice to your ability to compound your money. Now, touching again on the point about position size constraints. So Warren noted one additional reason for closing the fund. Due to AUM, he could basically not invest in positions where he could invest less than $3 million in a single position. So this obviously limited his investable universe even more. So let's transition to talking more about the go-go years in the 1960s. So Warren realized that his strategy, which allowed him to beat the Dow by such a wide margin all these years, would basically no longer work as it once had. In 1969, he ended up closing the partnership down, stating, I would continue to operate the partnership in 1970 or even 1971 if I had some really first-class ideas. Not because I wanted to, but simply because I would so much rather end with a good year than a poor one. However, I just don't see anything available that gives any reasonable hope of delivering such a good year, and I have no desire to grope around hoping to get lucky with other people's money. I am not attuned to this market environment, and I don't want to spoil a decent record by trying to play a game I don't understand just so that I can go out a hero. And with that, Buffett ended the partnerships and returned monies to his partners, or suggested they invest with him in Berkshire Hathaway or invest with his friend Bill Ruane in Sequoia funds. Interestingly, Warren could have actually sold his partnership to someone else, generating himself additional money. But he decided not to go that route because of his business philosophies. The partnership was originally built to make money along with his partners. It wasn't created to make money from his partners. So this big distinction, I think, is why he refused to sell it despite actually fielding offers for it. So there is a vital lesson from Buffett's reasoning for closing the partnerships that applies to investing principles. Namely, you should not drastically alter your investing principles just to make a quick buck while not understanding the risks involved with such an adjustment. Buffett understood that the market at this time was favoring more speculative investments that did not appear to have a good risk-return profile. The fact that more and more money was coming into the market was making his smaller and more obscure ideas harder and harder to find and justify investing in. So here's a wonderful quote Warren wrote about the high returns on speculative investments. My mentor, Benjamin Graham, used to say, speculation is neither illegal, immoral, nor fattening financially. During the past year, it was possible to become fiscally flabby through a steady diet of speculative bonbons. We continue to eat oatmeal, but if indigestion should set in generally, it is unrealistic to expect that we won't have some discomfort. Now, Warren noted that in the years leading up to the closure of the partnership, he was only able to find 2 to 3 ideas per year. I wasn't able to find a reference point about what an average year looked like for him in the 50s or 60s, but since he specified that number, say 2 to 3, I can only assume that it was a much smaller number than he was accustomed to. So I've now covered the bulk of Warren's ground rules, but there was a very interesting point of emphasis in the book about how Warren looked at stocks as bonds that I want to share with you. So part of the reason Buffett closed the partnership was because he saw returns for the Dow being lower than 10-year bonds. So at this time, tax-free municipal bonds were yielding 6.5% to 7%. Buffett thought stocks were unlikely to rise by more than, say, 6% per annum and pay 3% dividends. This gets you a 9% return, but remember, this is pre-tax. So to make the two comparable, Buffett reduced the 6% return from stocks to 4.75% and the dividend yield from 3% to 1.75%. When we add these together, you get 6.5%, which approximates the yield on tax-free bonds. For this reason, he assumed that the vast majority of money managers would underperform the market. Due to elevated prices and additional frictional fees, I think this is part of the reason that he was so reluctant in trying to name other managers he trusted to provide similar results to the Buffett partnerships after it was shut down. Now, I want to conclude this episode by going over 6 of my biggest takeaways. Number 1, a good investing track record requires 3 to 5 years of experience going through a full market cycle. Number 2, an investing track record does not mean your returns are always going to be positive. In fact, beating your benchmark in down years, even with a negative return, is still a sign of outperformance. Number 3, any stock pickers should be able to state their investment goals and not move the goalpost if performance suffers. If a money manager constantly moves the goalpost, that is a glaring red flag. Number 4, make your own decisions and don't rely on validation from other people or the market to impact your decision making. Number 5, if you think like everyone else, expect the same results as everyone else, which is underperformance. And number 6, don't destroy timeless principles to warrant unnecessary risk-taking. Thank you so much for tuning into my episodes today. If you want to connect on X, feel free to follow me at irrationalmrkts or add me on LinkedIn if you'd like. I'm always striving to increase the quality and value of each episode that I release. So please feel free to provide me with any feedback you have, both of the positive and negative variety, so I can enrich your listening experience. Have a good one. Judging performance based on short-term results from the market is going to cause all sorts of just poor decision making. You'll think you're a genius when you're lucky, and you'll think you're an idiot when you're unlucky, which is why thinking of the stock market as an abstraction is so important. Lynch shares a wonderful point that Warren made about the stock market. The gist of it being that Warren doesn't believe that the stock market exists. The only reason it's there is as a reference to see if anybody is offering to do anything foolish. This helps him make the market his servant and not his master.